It's Saturday, April 16th, and it's 9 o'clock, and we do our weekly investing webcast. So the topic of this one will be Stamps.com. Stamps.com is a roughly $1.5 billion company. They have close to no net cash, so it's a $1.6 billion enterprise. And I just find it funny that that's the same enterprise value roughly as Yahoo, which is one of the most popular websites ever created. So it's kind of funny if you think about it. You know, an example of a really kind of popular asset, but not a valuable asset, and then sort of a not so popular asset, but a very valuable one, or at least it is right now as far as the stock market's concerned. So anyway, let's go to the model. So 17 million shares outstanding, $93 a share, so very small amount of shares outstanding. I think most companies have more than 17 million shares outstanding, so they've kind of elected to not split their shares or for whatever reason keep a small number of shares outstanding. And they have 75 in cash and 160 in debt, so a little bit more debt than cash, but pretty close to the same enterprise value, at least as of the last quarter. So Stamps.com does what you might think they do. They're sort of a mail services company. So they help, seems like they help customers with mailings, not just with stamps, but labeling and packaging and things like that. And this is a big industry. It's become a bigger industry thanks to the rise of sort of the Amazons and eBays of the world. There are more and more kind of small businesses that really rely on the mail system, and it's very closely related to the United States Postal Service. So we're going to have to really kind of spend a lot of time thinking about the U.S. Postal Service and kind of exactly what it does and just sort of what the relationship this company has with them. Finally, the company's been somewhat acquisitive lately. So in the last 2-3 years, they've bought 3 companies, and you just have to be very careful when you have acquisitive companies, because you might see, like for instance here, you see the company's gone from 80 some odd million in revenue to 300 million in revenue is what they'll do this year. Their guidance, which is what management's projecting, is 290 to 310. So they've more than tripled their revenue in less than 10 years. But, you know, part of that growth has come from acquisitions. So the last probably a good half of it or a third of it has come from just acquiring other companies, which we like to call inorganic growth. And organic growth is just the growth of your business. Now they have both, but it's something to consider. Like say for instance in 2010, their revenue only grew 4%. Which is kind of a very pretty tepid growth rate. But you know, even without acquisitions, they kind of grew 19 and 14% in these years. So really kind of depends. So anyway, let's continue. They don't. So what's interesting about this company is that it's a so-called software as a services company, which is it's a popular term on Wall Street today. It's called SaaS, software as a service, and we see a lot of these SaaS companies in the sector we're looking at, these kind of internet companies. And basically the concept is that, you know, we used to, before SaaS was the buzzword, we used to call web services. This was way back when, 10, 15 years ago. And so the idea is that your software is this indispensable service that you could use kind of on demand on a website. Probably the best example of it is Salesforce.com, but there's lots of different examples of it. And the point is that Stamps.com is a so-called software-only business. So they don't actually. It's pretty incredible. They don't actually mail anything. They simply charge a small fee for buying stamps. So it's sort of a markup. And as you can see from the model, their margins are enormous. They have 80% gross margins. And what's amazing is you can have these really kind of low margin businesses on the internet that are normally low margin businesses, but you just strip out the kind of one piece and you make it your high margin business. A good example was looking at this company, 58.com. This is a kind of an e-commerce company. It's a Chinese company. I'm still just looked at it briefly, but you can see they have this huge gross margin, like 90% gross margin, and what they do exactly is they're focused somewhat in the retail area, and it's kind of an online e-commerce kind of networking website. It's kind of bizarre, but the point is that that you can have a very high margin business that's just sort of a service company based on a low margin business. And the post office is a very low margin business, as we know. The post office did $69 billion of revenue in 2015, but still lost money. And that's a lot of revenue, right? That's more revenue than Pfizer or Merck, or a lot of tech companies like Microsoft. But they still lost money. That means it's a low margin business, it's actually a negative margin business, because they actually have to deliver the mail, whereas Stamps.com doesn't deliver anything. They kind of just sell a little markup on the stamp, and that's it. So we'll talk about why you would use Stamps.com and all this stuff in a second, but let's talk about let's sort of talk about the business. So anyway, as of last quarter, they had just bought this company called I knew the pronunciation. I got to remember it because I listened to the conference call a few times. Indicia, I want to say. Indicia. And anyway, they bought this company, and they were a big competitor in a way. Stamps.com kind of focused on, at least according to them, kind of small businesses and individuals, but really what Indicia did was Indicia, there you go. Indicia did is more high-end, larger businesses that did a lot of volume, sort of high-end, high-volume businesses. Anyway, you can see the revenue jump quarter to quarter, and that's partially because they included some revenue from when they closed the Indicia acquisition. So they closed it in November. I want to say it was November 18th. There you go. So you're only allowed to book revenue after November 18th. So any revenue Indicia closed or generated in October, let's say, normally would be in Q4, but they didn't technically own it until November 18th. So that's kind of the nature of that. So, so I made some forecasts, but I thought that, so a company like this, it's important to just examine what the business is at the start. And what's important here is there's this 80% gross margin. So 70 million in revenue, and if you do trailing 12 months, you got 214 million in revenue and 170 million in gross margin. And because this is a software as a service business, one of the things to keep in mind is that a lot of their customers are, one of the things about software as a service, a lot of the customers are subscription model or recurring revenue. So basically someone signs up for your business and they pay you in perpetuity until they cancel. And that's why these businesses are pretty exciting, the SaaS model, because you have a high predictability of revenue. And the biggest challenge is actually just attracting customers. So that's where sales and marketing comes in. So obviously they sort of need sales and marketing because for customer acquisition cost and to increase customers and also to keep their current customers. And if they didn't do that, you'd have sort of a slowly declining business. And we could also sort of think that through. Let's do that. So you have $170 million of revenue trailing 12 months. It means the last 12 months. So if you have that and you think about, let's just say Stamps.com decided to just stop attracting new customers, stop updating its software, and run a bare bones business of kind of as little as they needed to do. They obviously need some kind of office and someone to, collect the checks and deposit them and make sure the system's up and all kinds of stuff like that. But in general, I think you could do that for, say, $30 million, but not attract any new customers. So they would actually have $170 million. And if you think about that model, so they'd have $170 million, probably cost you about $30 million to run your business. So you'd be left with 140, and then after taxes, you'd probably have $91 million. So that 91 million would erode over many years, as you can imagine. It would drop year after year after year. And if you think about it, it would be roughly 16 times earnings, and it probably wouldn't make sense to buy the stock. But that's something that you might want to think about, and I like to call that the runoff model. Because what you end up sometimes seeing in businesses is they're actually worth more dead than alive, which is kind of a grotesque and dark way to put it. But the point is that sometimes you have management that's spending and wasting so much money on their infrastructure. And Stamps.com, luckily, it doesn't look like that. But sometimes you have that, and you just say, well, what if I just shut this thing down and just harvest the cash? And sometimes you find opportunities like that, and you can take advantage of it. So anyway, let's get back to business. One of the things I noticed is they haven't really paid taxes, and so the things you can do in business is you can use your old operating losses and use them to carry forward and apply when you're unprofitable. Use those losses to apply against your profits. Eventually, this ends because you hopefully didn't lose too much money in the past, but this company has accumulated a few $100 million of losses. So they don't have to pay taxes for a few $100 million going forward. The way that works is very complicated. NOL accounting is pretty complicated. But sooner or later, they're going to start paying taxes. And what you have to keep in mind is this is a Delaware-based company. At least I think it was. This is actually a good time to go ahead and open up the SEC's website. Yeah, I forecast that they'll burn it somewhere around then as well, Alex. So the point is that they're a Delaware. Are they a Delaware company? Yes. They're a Delaware incorporated American company. So that means, and all of their business, as far as I can tell, is U.S. business. I mean, I don't know why you would want a U.S. stamp company unless you're a U.S. customer. So all of their business is U.S. business. So their tax rate will inevitably be 35 or 40%, which is what I forecasted at. Unlike a multinational company like an Apple or a drug company, for instance, their clients are only in the U.S., which is going to be problematic. So I think that that's just something to think about. Now they could get a buyer who would lower their tax rate. That sometimes happens, but it's something to keep in mind. So as you can imagine, like in many of these kinds of companies, like we did with Netflix, here we have the same sort of thematic. Same theme, which is stuff we did offline, we're now doing online, and that's sort of the theme of basically all of these internet companies, right? And there'll always be a mail system. Now you can see that the mail system's declined, and this is really remarkable. The amount of mail that the USPS has sent out has declined 28%. The revenue has only declined 5%, and that should really be amazing to you. And the reason for that, can anyone guess how that's possible? How do you send out 28% less mail over 10 years, but actually only reduce your revenue by 5%? Does anyone know how that's possible? 28% less volume, but revenue only declines by 5%. Anyone really smart out there? Not packages, no. Yeah, higher prices. Higher prices. Yeah, higher prices. Shipping, the USPS has spent a lot more. This is revenue, right? It's spent a lot more money. Volumes have declined. The only thing that's made up for it is pricing. Higher prices. Maybe mix shift as well, but it's basically prices. So revenue has declined, but volume has declined vastly, vastly more. So the point is that the USPS has increased prices quite a bit. In fact, if you look at the price of shipping something in 2006 versus 2015, it's quite a lot higher. It's nothing to do with logistics or anything like that. It's just demand. This is all demand side. So in any event, first class volume has declined remarkably. It's declined 54%. So higher prices, surcharges, things like that. That's all kind of increased 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 revenue while volumes decline dramatically. So, and the point is, if you look at retail revenue, has actually grown for the post office. The actual revenue that the branches bring in has grown. So, and yeah, you definitely have some issues with price ceiling. At some point, stuff gets so expensive to send that you find alternatives like FedEx or whatever. But if you ever used FedEx, FedEx is pretty expensive in and of itself. So anyway, let's get back to the point here. So last quarter, it's interesting. They kind of the postage value of what they shipped was $1 billion last quarter. So what does that mean? That means that $1 billion of postage. So this is the actual value of the shipping cost. They only recorded 70 million. So they are getting about 7% of the postage value. And if you look at the postage value for the US Post Office, like I said, it's about 68 billion. So, and if you take the last quarter or you take a forecast for 2016, they're going to do about 4 billion. And so maybe this will decline a little bit. And so the point I'm making here is that of all shipping periods, Stamps.com is sort of accounting for 7% of it, which is quite a lot, quite a bit more than you may have thought. And if you look at the actual post office's website, USPS.com, what's really fascinating is that their revenue is only 500 million or so, and it's about $1 billion if you include not just Click and Ship, but their entire USPS.com. And I actually signed up for both USPS.com and Stamps.com today, and I found the Stamps.com service and website superior and probably worth paying this small amount extra. It was worth paying for. So yeah, I added 1 decimal point here because the numbers are so small. So anyway, the point is that they actually have quite a bit of market share. And if you think about the amount of postage volume, if you will, that sort of is offline and is coming online, I think you can see a pretty big growth possibility for this company. One thing that gave me some confidence about that is a long time ago I actually I wouldn't say I worked in a mailroom because I did a lot of things, but one of my responsibilities was a lot of the mail for a hedge fund I worked at. And we used a company called Pitney Bowes. And Pitney Bowes we're a small company. Sometimes we'd set out a lot of mail to our investors and so forth. And Pitney Bowes is basically a mailing and shipping company. And they make these little kind of stations, these postage meters. Here's like this actually doesn't look too different from the kind that I used, even though that was 15 years ago.
Post office getting in the way of your business? That's why so many businesses rely on the Mail Station 2 from Pitney Bowes, a leader in shipping and mail technology. The Mail Station 2 is a post office in your office, right at your desk, and smaller than a standard printer. Simply weigh your mail or shipment and get the exact postage stamped right on the item. It's easy to use, accurate, and fast, and the savings are big, with 1% saved on your everyday mailings. That way, when you send mail, you'll be saving time and money. Don't worry about running out of postage and minimize trips to the post office. Start your free 60-day trial today and put the post office...
So that's what Pitney Bowes does, and they have $3 billion in revenue, and the market cap of the company is $4 billion. So contrast that with Stamps.com, which is $1.5 billion company and does far less revenue. And Pitney Bowes margins are much lower, so it's really kind of an interesting, really interesting perspective. So anyway, I went through all the filings, and I sort of feel like one of the things that's really important in evaluating any company is the quality of the company's management. And I feel really good about this company's management. They've grown the company from day one. They've done a couple of what seem to be smart acquisitions. For instance, they paid just 3 times sales for Indicia, which I thought was 4 times sales. So 215 divided by 59, 3.5 times sales, which I thought was an impressive acquisition. They bought it from Newell Rubbermaid, and I thought that was a really impressive acquisition. And what's interesting is they used all cash and debt, so they didn't issue any new shares. So it looks like it's going to be a really accretive acquisition because there's a lot of overlap in what the companies do on a cost basis, but from a revenue basis, it looks like it'll be accretive on a cash flow basis. So we'll have to see. But if last quarter is any indication, it should be very accretive. So I think that the numbers could be a lot higher than what I'm envisioning. And of course, I have them starting to pay tax relatively soon. So I think that the transition from sort of offline to online will continue, and that there are 300 million in revenue based on sort of 7% of all postage volume. And I know on the conference call they say that they're about 30% of I want to say first class deliveries or something like that. But regardless, I think they can continue to grow. And one of the things that I think is really important, and you can ask yourself this when you look at companies, is how do you forecast their future growth? Eventually, management will hit a wall with whatever they're doing, and like in 2020 or 2025, and you have to sort of trust them to do something smart. And what this company's already started talking about is getting involved in, I'll show you sort of a little bit from there. They've talked about getting involved in non-postal servicing, which I thought was really cool. So they've done really well just working with the post office. But you can see that the other carriers, FedEx, UPS, and DHL, they could, I think they've been talking publicly about them getting into those channels as well. So they've dropped some hints about that, and I think that if you think about that potentially doubling or tripling or quadrupling their growth, that could, or their opportunity at least, that makes a lot of sense to me. So what I did is I sort of modeled them declining. I modeled 2016 as accurately as I could, and it's a growth year because of the Indicia acquisition. So you just have to you have to do a lot of complicated math to sort of understand that. So when you buy a company, I'll show you kind of what I did. I'll show you briefly. When you buy a company, you actually have to disclose its operations. It's sort of complicated. You have to get an audit for that company, and this ends up being a real pain in the neck. So here's what it looks like. Stamps bought Indicia, and here you have to actually go ahead and release unaudited, and in this case, I guess they're both unaudited, but you have to release financials to explain to the market what you bought. And my understanding was actually to be audited. If you can't get an audit, maybe you can do the unaudited. But anyway, here you have Indicia's actual, their balance sheet and their income statement. So they did 48 million in revenue for the 9 months ended September 30th, and they did 58 million in revenue for the entire year in 2014. So you actually have to look at this and say, okay, 58 million, and you have to sort of project that there's some seasonality here. So if you divide this by 3, you can sort of see how much revenue they were doing for those 3 quarters. So 48 divided by 3 is 16, but I think they have this big fourth quarter. So if you think about it as, all right, they're on track to do maybe 68 million, let's argue, 68 million in 2016, or 2015. So if Stamps without Indicia was going to do roughly, say, 200 million, then the extra 68 gets you up to, that's 68 for 2015. So you got to sort of take the growth from the base business. So you have 68 million. Say that was going to grow 10%. So that's, call this 2015, call this 2016. So this is 200 million. Say that was growing at 15%. You can see it was sort of growing in that range. So then you add this up and you get about 305 million for 2016 forecast. Now management told us that on the conference call that is 290 to 310. And management tends to try to be conservative. So in any event, that's roughly what their revenue will be for 2016. So after that, I kind of took this declining revenue concept and just sort of assumed that they would continue to grow, that offline stamps and mailing would it doesn't concern me, Alex. Offline stamps and mailing would would sort of continue, but it wouldn't. I'm not expecting a miracle. So just with pricing, you could probably achieve a lot of this growth, and you have this big natural tendency for mail to for mailing services to go from offline to online, just like anything else. Like many things in life, there's this complexity that's being saving us time and energy by taking it sort of online. So even though there's going to be competition for Stamps.com, I think overwhelmingly the market is still pretty ripe, and this is what I think will happen. I'm sorry, it's not even just what I think will happen. This is sort of a base scenario. And basically, the way I do these investments is I say, right, let's assume this is what happens. I don't think this is too crazy. What do I get for a stock price? And here you can see that I get $164 a share. And I have a positive maturity, which I tend to not like to do. I have a very low discount rate, which for a SaaS company I think makes sense, because these are customers that are like locked into long-term contracts. Is the way they do business. They're generally not going to go away. And then most important thing is this concept. And this is sort of the idea that management is going to do something that I think is really smart. And I don't know what that is. No matter how good of an analyst you are, you can't really predict what's going to happen in 2020 or 2025. The only thing you could do is trust. This is the first quarter hasn't been announced for Stamps.com yet. It will be in the next few weeks. So we're in the second quarter now, in the early beginnings of the second quarter. So anyway, the point is that you can't really predict what will happen 10 years from now. Technology will be different. But the question is, will management actually do the right thing when it comes time to do the right thing? And I think that's the question. I actually give management really high marks, for this company. And I think that they'll continue to innovate, and they'll continue to sort of create opportunities for their shareholders over time. And the best way to express that is sort of return on invested capital. And this is a concept that we've been over a few times, which is sort of what happens to the cash that the company accumulates. Will they use it to do stock buybacks? Will they use it to do smart acquisitions like Indicia, which looks to be really smart? We'll see. And if they do, you can really get a lot of success. If management takes that cash and redeploys it correctly, you can really succeed. And so the best way for me that I found over the years to sort of forecast that is not to put sort of new revenue in here. I just forecast the base business, but I kind of think about it like a hedge fund returns or investment vehicle returns. I think of it as they're going to generate 10% return on capital on the capital they accumulate. And whether or not they give you that capital and you have to generate that return is up to you. But that's sort of one way that I found a very successful way of thinking about it. So I have a large respect for management. And the point is, as investors, you have to watch management closely on the conference calls and the actions they take. And if you start to lose confidence with them, or whatever, investing with them, then you can sort of tend to take down take down the ROIC as well. So I don't think mail is disappearing anytime soon. People like the mail. Most of the stuff that they do is actual packages of goods through like eBay and Amazon vendors. So in any event, this is sort of what I'm thinking will happen. I think that they're a really smart and skilled management team, and that a lot of it's in the eye of the beholder. But based on what they've done, that's sort of my opinion. Now, if I decided I didn't like the management team, let's say I said they're not going to return much, there's going to be negative growth at maturity, and it's a 7% discount rate, all of a sudden the shares are fairly valued. Now remember, I'm not giving them heroic growth assumptions. They could actually grow quite a bit larger than this for quite a bit longer time, and I think they can make some margin improvements. So if it's fairly valued with relatively achievable kind of forecasts, it could be worth a long if they tend to beat these numbers. And I think they will beat these numbers. So it doesn't give you a lot of safety and margin of safety, but vis-a-vis other stocks in this industry, I like this one quite a lot. And I think there's a bunch of shorts that we could short while we buy Stamps.com. So I think it's a buy. But we have to see how the Indicia acquisition plays out. I think they're being conservative with their guidance. I think they'll beat numbers. and then I think they'll continue to grow over the years. So I think they'll do at least 60 million in cash flow, probably more than that. And compared to Pitney Bowes and sort of all the other opportunities in front of them, I think they have a lot more success ahead of them. So anyway, that sort of was my take on Stamps.com for a quick half an hour. I want to buy the stock, and what I would do is I want to sort of buy the stock, and I guess I'll buy the stock on Monday when the market opens. So what we'll do is we'll see what price we get, and let's see, position. So probably I'm guessing we'll buy $25,000 of the stock. The current price is 93, so maybe we'll buy, I don't know, 500 shares, maybe something like that. So $50,000, and we'll sort of see how the investment plays out, and we'll start to build a portfolio of internet stocks. So we'll see what happens. So let's take a look at some of the models. You guys sent me a lot of models, so I want to take a look at a few of them. This first one comes from Wilhelm Langborg. What a name. What a name. What a pro. All right, let's take a look at this trash. My cat's name is Trashy, so we'll see how trashy this model is. All right. I don't think their competition is USPS. Well, I guess their competition is USPS, but I don't think their competition is FedEx. FedEx actually takes the package from point A to point B, whereas Stamps.com doesn't have any trucks or anything like that. This, I don't know what this is. This isn't the way I tend to do things. Let me give everyone a grade. See who wins the competition. Issuing new shares. I don't know about that, Wilhelm. All right. Let's see here. A little hard to read, but he kind of gets the gist of it, which is that yeah, this is pretty good. A little ugly and hard to read, but pretty good. Let's see how he builds his revenue. It's pretty conservative as well. Okay, it's not bad. So he gets fair value. Where's AA33? Good. Yeah, I thought this was pretty good. It's pretty good. It doesn't have any information. I'll give you a B. No information on USPS, which would tell us why the trend towards printing stamps will continue. So very little actual research was done. This is just numbers, not a lot of research, practical research. So not a great score for Wilhelm, but the general idea, he kind of gets the idea of finance, which I think is good. All right, let's see. Who else? Gerard. Let's see how Gerard did. All right. Gerard White. Well, it would have been nice if you could put the what quarter you took this out from, because if I was looking at this model months from now, I'd want to know if this was fresh, and then you got sort of 2 decimals here and no decimals here and 2 decimals there. It's sort of a little not very pro. Kind of like this touch with the link. Kind of like that touch. This you could just use as comments, but it's very impressive that you would think to put the acquisitions down. But you could just put them as a comment like that. But I think that's a good idea. So let's see here. I like how you totally ignore management's guidance. You just say 333 million. It's obvious you didn't listen to the conference call. Oh, maybe you did, because they said Q1 would not be as successful as Q4. But yeah, management's often softball is what do they call it? They lowball. Oh, your revenue growth, your formula is wrong. It has to be -1. Because 145% growth means 2.5x, so you have to do the -1. So that's a pretty big mistake. So just for everyone watching, new divided by old -1 as a percentage is change. That's really important. You got to have the -1 in there. Very important. Okay, so this is interesting. You have them. Bizarre. What the heck? I don't even know what you're doing here. Last year. Yeah, this is definitely bizarre, but in essence you have them. Alright, dude. I can't even. This is trash. I mean, it doesn't even, you're not even telling me what you think the company's worth. I mean, I could just put it in here. No tax, you assume they'll never pay taxes ever again. Okay. That's interesting. I'd like to have their business model. Oh man. Alright. Sorry, bud. You get the trash rating. You took some decent notes. All right, Jared. Don't be discouraged because I referred to your work as trash. Your next work could be good. Never know. It's not likely. Okay, this is from someone named Byron. See how Byron did. I can almost tell immediately that this is going to be trash. Alright. Doesn't freeze the panes, so that's an important thing in Excel, is just freeze the panes here, so if I scroll around I can still see what I'm looking at. There's no attempt at a real attempt at forecasting much of anything. Oh man. I don't know, this is sort of like, I have to upgrade Jared from trash to an F. This is true trash. This is the first time I've ever described this garbage. Wow. Yeah, I just can't even. You know, I provide you guys with like 50, no, over 100 models as a template. Just look at mine. Jesus Christ. I like the address, El Segundo. That's really helpful information, dude. How about... Oh boy. These aren't even the right numbers. I know, where'd you get these numbers? You made them up. Oh my god. Alright. Alright, Ben sent this one in. Alright, I gotta guess close out my model to look at Ben's. Alright. Alright, Ben Goldstein sort of maligns my... I don't know what this is, market cap minus enterprise value? I guess that's the cash, the net debt. It's a little bizarre. My lack of accounting skills and my lack of both time and inclination to properly learn contingent consideration left a bit lacking on my income statement model. Oh, Jesus. Not being from the USA, dirt company, dirt stock, leveraged option. What? All right. This is a dirt model. Discount rate of 10%. I think that's a little excessive. He sort of gets the idea of forecasting cash flows, which is, you know, better than I can say for some of you idiots. Projected price of $25. That's a lot lower than their current stock price. Certainly possible, but the problem is these forecasts. Like for 2016, the company is telling you it's going to do 300 million in revenue. So you have them doing 220 million in revenue. You don't have any explanation as to sort of how or why that'll happen. Yeah, projecting 3% revenue growth when they were doing 60% revenue growth seems a little too conservative. All right, Ben. Garbage forecast, but congratulations on understanding the finances. Okay. All right, Calvin has got this model. It's a lot of models, Jesus. You guys really outdid yourselves. Again, you should have put down what quarter you took this information from, because otherwise I open the model. I don't know if you did this. I guess this was your attempt to do it, but you could just put down Q4 right there, and I would know. I like that you pointed out that they have this big risk of the Postal Service is their only sort of partner. Right, this is confusing to me. What the heck? This is exotic. You need to forecast their future cash flow. That's important. Let's see if I sort of did that over here. Right, revenue 317. Kind of more or less get it. 25% tax rate. Taxes are higher in this country, turns out. Then you have this sort of bizarre flat revenue, forever and ever and ever and ever. Okay. And then net income becomes shockingly negative. Wouldn't they just stop? Wouldn't they just stop? Yeah, you gotta do this again. No company would sign up to lose money, so you gotta understand that like these, at some point they would cease to lose money, right? Like they would rather not be in business for this last 10 years, I guess. And so you probably made some error in your formula, but it's just something to consider. I don't know why what's this asset? Doesn't make a lot of sense. Who's this again, Calvin? Yeah, there's no data here to suggest, anything about the conversion from offline to online. It's pretty poorly done, I think. Could have done much better. Frampton. That's quite the name. Can't say I've ever met anyone named Frampton. His first name, at least. All right, Frampton. What the devil is this? Well, Frampton's decided to do enterprise value to EBITDA multiple. So why would 20 or 30 be a good multiple? He doesn't explain. And he uses the WACC, which I don't recommend. But it gets a discount rate of 7%, which is reasonable. Yeah, this isn't projections, this is, or at least it doesn't look like it is, because this should say 18, this should say 19, this should say 20. Yeah, I don't subscribe to this kind of, I don't know why their margins would jump so much. Yeah, I think this is a poorly done model. What was this guy's name again? Does anyone remember? Frampton, right? Frampton. All right. Max. At least you got a normal name. You get some points for that. Let's see how Max's model looks. All right. Intro. Nice. I like it. I like it. Doesn't put what quarter he got this numbers from. and they're different from most people's numbers. They only have 157 in debt. All right, let's take a look. Again, you missed guidance. I mean, that's not a reasonable, like you didn't do, yeah, this is a little messed up. Like, you have 318 here, but then you 243 there. It doesn't make any sense. You didn't sort of think about, like, Indicia alone gets them to close to 300. So the forecasting I thought was really poorly done here. Taxes, they'll get to 35%. I don't know why you would do 20%. US tax rate's like 35% for a corporation. Margins going up a little too fast as well. You have margins going from 20% to 40%, which seems unlikely. But, you know, you kind of got the idea. What was this guy's name again? Max? Still nobody with a decent model. That's not good. Alright. Keep trying. One of you guys will get it right. Zach. Perhaps Zach's model is right. Oh my god, it's a virus. Ah, no. No, it's a virus. Oh my god, it's got all my hard drive information. Oh my god, my bank account. No. Shoot. Is anyone out there a computer security expert? Crap. I'm just kidding. It's a model. All right. It's just kidding. So you got the debt number. You got the debt number wrong. Nick Lim, God, Nick Lim, I got you. Daquan. Daquan's got me. Alright, let's take a look. Yeah, Zach, you're missing the beat here. Company's saying they're gonna do 300 in revenue. You've got 235. You gotta listen to those conference calls, dog. And where's your 2016 quarterlies? Tisk, tisk, tisk. 5% discount rate. That's pretty ambitious. 3% growth at maturity. That is not a good idea. A lot of issues here, Zach. Remember, it's perpetuity. Sorry, Zach. You definitely made a lot of mistakes. All right, Harris. Harris says, hopefully it's not too trash. Let's see, Harris. Harris is one of the more famous and popular YouTube chatters here, but I won't reveal. He's anonymous. I won't reveal which one of. He might be Snappy. He might be, who knows. All right. So let's see. You got the wrong debt number. You didn't put what quarter these things are from. List of patents. All right, yeah, that's pretty cool. You got a bunch of links here. Pitney Bowes competition. Pretty cool. Look at this. Look at this. What a god. Oh, oops. Thank you. So yeah, this is from Harris, which nobody knows what. Nobody knows who Harris is, but he's one of us longtime YouTubers. And he throws in this quote from Common Stocks and Uncommon Profits. This scholastic-like investment expert would sit all day in undisturbed isolation, poring over vast quantities of balance sheets, corporate earnings statements, and trade statistics. From these, whose superior intellect and deep understanding of figures would glean information not available to the ordinary mortal. This type of cloistered study would yield invaluable knowledge about the location of magnificent investments. That's from the book I recommended, so I'm glad you actually read it. What's really fascinating about this guy, Harris, is I know his identity. He's actually very young, which is even more exciting. So let's see how he did on his actual model. And he begged for me not to call it trash, but I don't know, we'll see. I'm not going to be nice to you. Let's see, where's total revenue? All right. He's got the guidance in there. All right. He's got a really aggressive revenue growth for 2017. That doesn't seem realistic, Harris. And then all of a sudden in 2022, he assumes drone delivery. Wow. That's an A+ for creativity. I guess I didn't think that through. My mind is blown. Drone delivery. This intermediates stamps.com and the Postal Service. Huh. I'm literally just stunned. Drones. They didn't fucking think of the drones. God damn. The drones. All right, so I'm gonna give this guy a B+, which I think is the best rating so far. Harris. Yeah, the growth that you have in there for 2016 to 2020 is just arbitrary, right? It seems like it's arbitrary. Let's see. Yeah, it seems pretty arbitrary. You just picked a number and said this is how much they'll grow, which is not a smart way to do things. Then here with your negative income, and they're not going to consciously generate negative income in perpetuity, right? Why would a company say, let me lose $46 million a year? That sounds like fun. They'd rather just not do that, right? They would just say no more, right? So you kind of miss that. 12% discount rate's a little high, but your growth rates are also kind of crazy. And obviously, if their revenue is going to grow 30%, their costs should grow a little faster than what you've got here. So a lot of messed up forecasting. But creativity is really important in investing. Really, really important. And everyone talks about drones for delivering things. And I don't know, this company, they would have to somehow get into the drone business, and they're not in the drone business. I don't see anything about them in the drone business. So I'm pretty impressed. Like I said, creativity is really important. You can teach someone how to forecast. These forecasts are not good, and I'll teach this guy one-on-one how to forecast because I like him. I think he's 16 years old. I'm not totally sure. But the drone insight is pretty impressive. Now, I don't think, even with drones, I don't see mail going away in the next 10 years. It seems unlikely that you could even, you could even have that many drones. Because if you look at my model, let me close out this crappy model. Funny. If you look at my model, you'll see, and this is why it's important to do this kind of research, the U.S. Postal Office made 155 billion deliveries. Right? Think about that. 155 billion deliveries and 500,000 people work. 500,000 people work at the post office. So if you think about that, it's very unlikely that drones will cause this dramatic decline so quickly. It's up to Harris to tell us who he is. If he wants to stay anonymous, then he's going to stay anonymous. But that's creative. I hope he's not the best model because the actual modeling sucked. But we'll see. Right, this guy is AK or AK. And he submitted a model last time around, so I don't recall how trashy it was, but I do recall it being pretty bad. So let's see how he did this time. Notice no women have sent me models. Apparently, guys are the only people who want to make money, so go figure. STEM, man. It's all about STEM. All right, let's see. AK, we'll call him. Aki, there you are. You got a D- last time. All right, let's see if you improved a little bit. Okay. I don't know why do people think that the debt is 215? Do I have to teach you guys how to contingent? Yeah, I would just take the debt. Contingent shares is it not even, that's not even cash debt, right? I see, okay, maybe. All right, I won't be too mean about that. Ooh, I like this. Addressable market. A lot of small, family-owned and sole proprietorship businesses. Okay. of background information. Let's see the model. Always keep it at 100%, otherwise you can't really see it. This is pretty good. Realistic, conservative forecasting for sure. %7 discount rate. That's roughly the same I used. Yeah, this is good. Oh, I definitely like this. And you had more information than most. Let's see here. This could be the best one. And to go from D- to still hairs from the block. That's not the real guy, by the way. I think you get the winner so far. I have one complaint. I got one complaint. You get an A-. Forgot about drones. Oh. And some minor formatting errors. And probably too conservative a revenue growth. Yeah, great job. And really improved over your last model. Congratulations. All right, Kalen or Stanley. I don't know who this is. Stanley A. Sounds like maybe somebody else's email you sent it from. Yeah, it's really good. You could definitely work in finance with that kind of work. This guy doesn't know how to format to save a life. Stanley, the manly. Stamps.com will unlikely capture very much of its prescribed capturable what? Some of this stuff is good, some of it isn't. Stamps isn't a new company. 9% discount rate doesn't sound right. Software as a service. Did you not listen to the call? They have some guidance. There's some issues here. Alright, Stanley. Giving you a B minus. Good attempt at primary research, but a lot of fallacious conclusions. Poor formatting and strange choices for forecasting. Okay. All right, Jason Yan. Let's see how Jason did. There are so many of these. Jesus, thank you all for participating. Okay, this is definitely the most comprehensive one. Look at this. Jesus Christ. This guy went ham. Well, this is just Edgar, but this guy definitely went ham. No, there's a prize. Sure, I'll still give out the $1,000 prize to the best model. It's up to you as to whether or not you want to reveal yourself, Harris. So far, you're winning. Just because you write a lot of stuff doesn't mean you win. You can write. You can do. Yeah, I'm just gonna search for drone. If there's no drone, you lose. I'm just kidding. Yeah, like these forecasts seem not good. Formatting's terrible. Yeah, as I'm getting to $1 billion in revenue, and terminal value he does PE, which I don't love. It's bizarre. Yeah. Pretty bizarre forecasting method here. Not very good. Yeah, the real Harris is bad boy. He is that is correct. They didn't want to reveal his name without his authorization. But yeah, it is really impressive. And he's not yet. I don't even think he's in college yet. So, they're really, really impressive. This model got me thinking because I didn't look at the options. Senior next year in high school. Wow. That's really impressive. I mean, this guy put a lot of effort into this, but I think that like if you look at his just before how he gets revenue is, for instance, is really just very, very poorly done, I thought. Discount rate of 5%. Yeah, this is so bizarre. All right, so Jason, I'm gonna give you an A. Maybe an A. Maybe A minus. B plus. Great effort and lots of principles used, but poor adapting. There's like a lot more. It's crazy. I'm gonna try to go a little faster. There's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 more? Jesus, you guys really All right, Louis DeMaria. I don't even know what's going on here. Terminal value, okay. Fine. Should be plus 25%. You have them getting to $1 billion in revenue, so a lot of growth in here. Discount rate of 12% is a little crazy. That doesn't really make sense. Their customers are very sticky. They'll be with them for a long time. I mean, most of their revenue comes in monthly contracts. But you have a high growth rate, so kind of makes sense. I don't think postage volume will grow. It'll probably shrink. It's been shrinking. I like the way you kind of thought through the revenue growth, though. This is pretty good. It's pretty good. Yeah, I thought this was really good because you used postage printed as your metric, and I didn't tell anyone to do that. It's exactly what I did, so really good. Just a weird discount rate, I thought. Probably some other mistakes. A little lazy. 25%, 35% taxes, that's good. This is weird, discounted. That's fine. Yeah, that's good. I like it. Nice job, Lewis. Steven. What's Shibu? Never heard of it. Nice. This is like a Pitney Bowes competitor. Cool. No one else mentioned Shibu. Yeah, great job, Lewis. This guy got the message as well. I don't think your maturity worked. You have to freeze pane. You have to freeze the number with F4. So like, because you have, it's right for the first one. Take a look. It's right for the first one, but then the next one assumes it's assuming it's not taking the right argument. So made a mistake on that. But otherwise, you know, I like it. It's pretty good. A lot of you guys are getting a lot of these concepts. So I mean, these are pretty good, realistic ways to value public companies. So. All right, Michael Flanagan. Isn't this guy the former winner, the former champion? Didn't he win last time? I forget. No, that's Matthew Vint. That's different. Flanagan lost. Maybe he came in second, I forget. Discounting is about your opinion. It's software as a service generally has low discount rates because the companies are people really stay with the service. I don't know if that makes sense. I don't think it should get more complex, John. It takes the hard part is the creativity. That's where the like the drone comment was the most creative thing I've seen all night, and I consider myself a creative investor. A lot of people do, and I didn't think about the drone concept. So it's less about complexity, and it's more about creativity and intelligence. The models themselves should be very simple. All right. So this looks the closest to like something I would make. So formatting here is like an A+, I would say. As close as it would get. Let's see. 3%. Tax rate, you should be bumping to 35%. Growth, growth's pretty low, but fair. If you're gonna have growth that low, I would have the discount rate a little lower. And you have no interest income. I mean, if the company is gonna accumulate all this cash, they're gonna do something with it, right? Oh, that's pretty good. Verdict overvalued. There's a couple of faulty assumptions in here. But Pitney, you got Pitney Bowes in there. Curious where you got these numbers. Click and ship, I think, is software. This is interesting. I liked it. Yeah, John, that's right. I wouldn't say it's easier because there's sort of the future. All right, Alexandros, who's been too impatient. And then I have just 4, 5, 6 left, so. All right. Pretty good, front page at least. This is really nice, the Glassdoor analysis. That's definitely gets you some points for creativity. Very nice. Very, very nice. Let's see what this is. Good. Remember, I like the Arial font. This Calibri is just too harsh. Too harsh on my brain. It's kind of a weird forecasting method here. What exactly are you doing? ARPU and okay. I don't like this forecast. You should have done it on like postage volume, would have been better. 5%'s a very low discount rate. This is a riskier business than that. I'll give you a B, maybe a B minus. That's why I like doing this, is now you can use the glass door edition. You can use the glass door on any future models. So very good, Alexandros, for introducing us to the glass door tool. That's a nice tool to use. But I definitely thought your forecasting was a little off, and the discount rate and a lot of this stuff is just not. Like, you have this high growth company and then kind of have a pretty weird, I don't know. Yeah, weird forecasting method. The growth, growth just doesn't make sense. But I mean, definitely some bright parts here. I mean, you certainly got the NPV calculations all correct. Not bad, not bad. Definitely not bad. B minus may be unfair, but there's a lot of good models here, so I got a grade on the curve now. All right, Philippe. This guy's, I think, from outside of the US. Philippe with an F. All right, all good here. So you missed guidance pretty bad. I mean, you didn't do 2016 quarterlies. You have them growing to a lot. Let's see, you're growing it. Doesn't make sense to me. Are you forecasting revenue growth? Average revenue per customer, and you're growing customers in a somewhat arbitrary way. That's not good forecasting. I mean, you got all the concepts of finance down, but there's not much. You get a little bit of stuff here. Let me give you a C+. Discount rates are the heart of finance. Getting the right discount rate is art and science. All right, Henry steps up to the plate. All right. Format looks good. No research on, that's a problem. No primary research. You didn't even bother going to the post office's website, scumbag. You're just lumping in operating expenses. You have them grow 5% forever, even though revenue stops growing 5% or more. This is weird. I don't like it. Now look at how do you forecast revenue growth? Oh, this is trash. This is trash. All right, I'm going to give you a B. Good formatting though. Maybe give you a D plus to be nice. All right, Pavel. Just a few more after Pavel. Mostly USPS, I'd say all of USPS, right? No guidance, not good. And you have revenue declining 2% a year, but the company grows a lot. Doesn't make any sense. Poor Pavel. All right, Isaacs. Yeah, Mr. Isaacs or Mrs. Isaacs possibly. Let's take a look. All right, Jonathan. We got 2 more after this. Glad we're almost done. like this quote, some of these quotes, and it's pretty nice. Not the best model in forecasting. Something is going to grow 9% for 15 years. It's generally going to be undervalued. Let's see here. Yeah, I don't really see, like, where's taxes? Lots of issues here. You assume that they just don't pay taxes? Doesn't make much sense to me. All right, two more. Brian, and then Gagi, who sent his in like 5 minutes ago. Interested to see what that one looks like. All right, what the heck is going on here? This is not the format that I endorse. Yeah, you can't just take a random multiple and say, 23 times sounds good. Derp. Just pick it out of your you-know-where. That doesn't make any sense. And I don't see anything about postal service or stamps or postage volume or anything. This is just guesswork. I'm just guessing that it'll grow 21%. Why? Why would it do that? This is garbage. It's a waste of my time. Trash. Belong in the trash. I hope that you sleep in a dumpster tonight, just so you can understand what you put me through looking at that model. It's true trash. Garbage. That's the best you can do is go to your local dumpster tonight. Go sleep in there tonight. You can understand what you just put me through. Piece of trash. All right, Gagi, you're last but not least, I'm sure. This is like that, just like the last one we saw. The fuck? Gagi, you too, dude. Go to the trash. Go to the dump. Same. It's almost the same exact one. Right into the dumpster. Go. That's where you belong. Exactly. Yeah, Keel. Wow. What trash. Alright, so it looks like the best one was AK. Only one who got an A. Did an extremely good job. Forgot about the drones, though. Then we got Harris, or Bad Boy, with the creativity. Jason and Lewis, who did a good job. And then Flanagan. So we kind of had to decide who the winner was. It's probably AK. It's probably AK. Yeah, I mean, I might make it 5 winners. I might review them again to see. But I think that the trash bags, these 3 trashies here, should pay. You guys should pay these guys. Jared, you too. You guys should all give these guys money, which is probably what's going to happen if you invest in the stock market. And for winning, AK, I'd like to invite you to the investment committee as a junior partner. Do you accept? Bad Boy, you also are invited. Words cannot describe this garbage. Alright, you also get moderator status. Congratulations. So, I think it's a long... so let's say we're investing with $1 million. How much should we put in stamps.com? I vote to make it a 2% position. So 220 shares, 215 shares. Does that sound good? You guys agree? You want to... What do you think of Akil? Akil's the deputy managing partner. That means number 2. It's not hypothetical. This is the committee. That's a good idea, Leo. Time to take out the trash. I don't know, Akil. Or Aki. I don't think that matters. Yeah, there's too much confusion between Akil and Ak. Yeah, Snappy is the enforcer. He's just he just takes out trash bags. Drones make it a 1% position. The drone risk, the drone risk is real. Yeah, I don't know. I don't think drones are gonna. Maybe you're right, dude. So you're saying you don't want to go long? The forecast makes sense to me. Drones don't scare me. What do you think, Akil? I don't think you could replace that much delivery with drones. And drones are going to be expensive, so not everyone's going to opt for the drones. 2% sounds right, Akil says. You can always rebalance. All right, we'll make the 2% position. Yeah, that's right, bad boy. All right. Well, we got our 4-man hedge fund here, so. And I definitely like the Glassdoor thing. I thought that was the second most creative thing. Look up how people look at the company, view their own company at Glassdoor. That's, I think that's a good idea. And then, let's see here. Yeah, let's see. Jason, Lewis, and Flanagan. You guys can be analysts. Nah. Yeah, I don't know, Lewis. I think, yeah, exactly. I think you got it right. Okay, so let's look for another one. What's this real page? So for next week, maybe we'll do this one, real page. Never heard of it. Okay. Next week's assignment is real page. Special favor, I'll leave that up to your interpretation. Job recommendation, advice, personalized advice, whatever. Or you could take the cash prize. Real page, RP is their stock. Oh yeah, deadline is Saturday. No, deadline is like Saturday. Oh, deadline is before the lesson starts. All right, so if you need just one piece of advice is if you need help or you get stuck, best way to move forward is look at the models in the share drive. I'm surprised that a lot of you don't look at those. I mean, the format that I use is the format that I want you to use. And finally, you can just ask me. Find me when I'm in a good mood on the stream, and you can just ask. But I look forward to your real page models soon. And great job, everyone. And we got a record amount of 23 people submitted a model. That's really cool. I'm really proud of that. We got some good ones. We got some stinkers. We got 5 really good models where there was primary research, creative valuations, really impressive. I think that these top 5 models, they could have been just as well at a top hedge fund like an Oxif or a Citadel. They would have been just as appropriate for analysts in those positions. And obviously you guys don't have the same resources to make the same investment decisions, like commissioning a survey or talking to the CEO or whatever, but I thought you guys did A+ professional job that, people make millions of dollars, literally, on this quality of work that these top 5 guys did. There are people making millions of dollars that do that for a living. The rest of you would not get a job. Some of you deserve to be in the trash and live in a dumpster, especially the bottom 5. But the top 5, I would say, could make millions of dollars working on Wall Street. So good for you. Keep up the good work. And we'll do RealPage for next week. All right, guys. So thanks a lot for joining. That ends today's lesson.